Listen to me very carefully. You think wiring $20,000 to your grandchild for a down payment is a private, heartwarming family matter. You think because it's your money, sitting in your bank account, you have the absolute right to move it wherever, whenever, and to whomever you want. But let me be real with you, you are dead wrong. In the eyes of the Internal Revenue Service, a personal transfer over $18,000 to a single individual isn't just a gift. It is an alarm bell. It is a highly sensitive tripwire. And once you trip it, you aren't just helping out. You are opening the door to a brutal, microscopic audit of your entire financial existence. Welcome to the Masterclass. Today, we are not just talking about one single tax rule. I am going to expose a catastrophic, hidden loop inside the U.S. tax code designed specifically to trap seniors over the age of 65. Most people think the $18,000 gift limit is a tax. It's not. It's a reporting threshold. But here's the crazy part. The trap isn't the tax itself. The trap is the blind panic it causes, which forces seniors into a chain reaction of devastating financial mistakes. Does that make sense? Because if you don't get this, you're toast. By the end of this video, you will understand exactly how a simple, loving gift to a family member can completely wipe out your Social Security check, double your Medicare premiums, and trigger an automatic 25% penalty. More importantly, I'm going to give you the exact forms, the exact codes, and the exact sequence to reverse the damage if you've already stepped in it. Sit down, take notes, and pay attention. Because ignorance in this system doesn't just cost you money, it costs you your survival. To understand how perfectly engineered this trap is, you need to see it in action. Let me introduce you to Eleanor. She's 74 years old, retired, and living comfortably on a fixed income. She has her Social Security and a traditional IRA. She's done everything right, she's played by the rules. But then her grandson calls. He's buying his first house and he's $25,000 short on the down payment. Eleanor doesn't hesitate. She's a grandma. That's what grandmas do. She marches into her local bank and wires $25,000 directly to his account. She feels great about it. She's leaving a legacy, right? Well, think again. 2 weeks later, the nightmare begins. It doesn't start with a knock from the IRS. It starts at the bank. You see, under the Bank Secrecy Act, banks are absolutely terrified of federal regulators. They aren't your friends. When they see a sudden, unusually large outgoing wire from a senior's account, their internal algorithm goes into red alert mode. They don't call Eleanor to congratulate her. Instead, they quietly file something called a Suspicious Activity Report, or a SAR. Suddenly, Eleanor's account is temporarily frozen for verification. She goes to buy groceries, her card gets declined, and she's standing there wondering what on earth happened to her money. Panicked, she does what most people do. She looks for quick advice. She calls a cheap strip mall tax preparer, you know the type, and this guy carelessly tells her, "Eleanor, the annual gift limit is $18,000. You went over. The IRS is going to want their cut, and they might audit you." Now, you have to understand Eleanor's generation. She lived through an era where you do not mess with the IRS. To her, an audit is a death sentence. She's terrified. She thinks she owes the government tens of thousands of dollars. She thinks she needs to give her grandson even more money, just in case the IRS freezes every penny she owns. So, what does she do? She makes the most expensive mistake of her life. She logs into her Fidelity account. She decides to liquidate $60,000 from her traditional IRA. She pulls the cash out thinking she is protecting her liquidity and preparing for a massive tax bill. Right there, that exact moment. Eleanor just stepped on a financial landmine. She thinks she solved the problem with common sense. But in the world of the U.S. tax code, common sense will get you killed. She just initiated a chain reaction that will bleed her retirement dry. And the worst part? The IRS hasn't even sent a letter yet. They are just sitting back, waiting for the tax year to end so they can collect the interest on her panic. Let me show you the mechanics of the slaughter. Let's break down the mechanics of the slaughter. You see, when Eleanor pulled that $60,000 out of her traditional IRA, she thought she was just grabbing her own cash. But the IRS doesn't see it that way. To them, that $60,000 isn't savings. It is ordinary taxable income. It's the same as if she went out and got a high-paying job at 74 years old. This brings us to domino number 1, Internal Revenue Code Section 86. Look, most people have never heard of Section 86, but it is the law that dictates how much of your Social Security benefits the government is allowed to tax. And trust me, they are hungry for every penny. The IRS uses a devious little formula called combined income. Here's how the math works. They take your adjusted gross income, add your non-taxable interest, and then, just for fun, they add half of your Social Security benefits on top. Now, here is where the trap snaps shut. If you are single, and that total number goes above a measly $34,000, the IRS suddenly flips a switch. It's like a silent alarm going off in their basement. Instantly, up to 85% of your Social Security benefits become subject to federal income tax. Let that sink in for a second. 85%. Does that sound like a retirement benefit to you, or does it sound like a heist? Think about how insidious this actually is. Eleanor pulled out her own IRA money to handle a fake emergency caused by a simple $25,000 gift. She thought she was being responsible, but that withdrawal spiked her income. Because her income spiked, the IRS reached into her supposedly safe Social Security check and declared that the vast majority of it is now taxable. She didn't actually gain any wealth. She didn't get any richer. She just moved her own money from her left pocket to her right pocket. But because she moved it at the wrong time, the IRS charged a massive life-altering toll on the transaction. It's like paying a troll to cross your own bridge. And I'm telling you, the bleeding has only just begun. Most seniors think, okay, so I pay a bit more tax this year. Big deal. But they don't realize the government is playing the long game. They are patient predators. They don't just hit you once and walk away. They set a delayed trap that is timed to detonate exactly 2 years from now. This is the part that usually sends people into a total tailspin when it finally hits. Are you starting to see the picture here? We are talking about a total systemic collapse of a retirement plan, all because of one loving gesture. But wait, it actually gets significantly worse than just a tax bill. Before we move to the next domino, I need you to understand one thing. The IRS loves it when you panic. Panic makes you sloppy. And in the world of high-stakes finance, sloppy is the same as being broke. Eleanor was so focused on the gift tax monster that wasn't even real. She completely ignored the real monsters hiding under the bed. And those monsters are about to take a massive bite out of her health care. Is this making sense so far? If you're feeling a bit of a pit in your stomach, good. That means you're paying attention. Because what I'm about to show you next is the hidden tax that no one talks about. It's the one that hits you when you're most vulnerable, years after you've forgotten all about that check you wrote to your grandson. We are moving into the territory of IRMAA and the Secure Act 2.0. These aren't just acronyms, they are weapons of wealth destruction. If you have an IRA or if you're collecting Social Security, you need to see exactly how these two laws are about to collide in Eleanor's mailbox. Now we enter the stage of systemic collapse. You see, the government doesn't just want your money now. They want to make sure they get a piece of your future, too. They play the long game. They don't just hit you today. They set a delayed trap that is timed to detonate exactly 2 years from now. This is where Eleanor's story goes from bad to financial nightmare fuel. Fast forward 2 years. Eleanor is back to her quiet life, thinking the storm has passed. She goes to the mailbox, expecting a postcard or a utility bill. Instead, she opens a letter from the Social Security Administration that feels like a gut punch. It's a notice regarding something called IRMAA. That stands for the Income-Related Monthly Adjustment Amount. Now, don't let the boring name fool you. In plain English, IRMAA is a success surcharge on your health care. Because Eleanor's modified adjusted gross income, or MAGI, spiked so aggressively 2 years ago from that $60,000 withdrawal, she crossed another invisible threshold. The government looked at her tax return and said, "Hey, look at Eleanor. She's rich now. She doesn't need subsidized health care like the rest of the commoners." So they legally mandate a massive surcharge on her Medicare Part B and Part D premiums. And here is the kicker. This isn't a bill they send you in the mail that you can choose to ignore. Oh no. They are much smarter than that. They automatically deduct it from your Social Security check before you even see the money. It's a ghost transaction. One day her check is there, and the next month it's hundreds of dollars shorter. Eleanor's Medicare premiums doubled overnight. Her monthly Social Security check, which she relies on for basic living, basically vanished. But wait, it actually gets worse. Remember that panic withdrawal of the $60,000? In her rush to protect her money from the imaginary gift tax, Eleanor didn't calculate her required minimum distribution, or RMD. Once you hit 73, the IRS mandates that you take a very specific amount out of your IRA every single year. You don't get to choose, it's a forced liquidation. And the rules are incredibly strict. Because Eleanor pulled the money erratically and didn't follow the proper RMD calculation schedule, she actually failed to satisfy her exact RMD requirements for that year. She thought she was being smart by taking extra, but the IRS doesn't give points for extra. They only care about correct. Under the newly passed Secure Act 2.0, failing to take your precise RMD triggers a devastating excise tax. It used to be 50%. Now they've generously lowered it to 25%. But think about that. A 25% penalty on money you were supposed to withdraw correctly, but didn't. All because you were too distracted fighting the wrong ghost. The IRS slaps her with a $15,000 penalty on top of everything else. Let's tally the damage here, because it is absolutely staggering. She is paying taxes on 85% of her Social Security. Her Medicare premiums doubled because of the IRMAA surcharge. And she just got hit with a 25% excise tax under Secure 2.0. This is a complete, total financial collapse, all stemming from a $25,000 gift. Common sense tells you that giving your own money to your own flesh and blood should be safe, but the tax code tells you it's an opportunity to tax your retirement, penalize your savings, and slash your health care. It is a perfectly designed machine built to extract wealth from the unprepared middle class. Specifically, seniors who rely on gut feelings instead of the actual code. But don't lose hope just yet. Because I didn't bring you here just to show you the wreckage. I brought you here to show you how to rebuild. We are moving into the rescue strategy. I'm going to show you how to fight back. Breathe. Just take a second and breathe. This is the Masterclass, and I do not leave my viewers standing in a burning building without an exit strategy. If you or your parents have already fallen into this trap, listen up. If you are about to give a large gift or you've already pulled the trigger, sequence is everything. Do not improvise. Do not guess. Follow these 3 exact steps in this precise order to disarm the trap before it detonates. Rescue Step 1. Neutralize the gift tax illusion. Go to irs.gov right now. You're going to download Form 709. The United States gift tax return. Now, listen to me. You owe $0 in taxes. By filing Form 709, you are simply telling the IRS, yes, I gave my grandson $25,000. $18,000 of it is tax-free under the annual exclusion. That's your get-out-of-jail-free card for the year. For the remaining $7,000, you tell them to deduct it from your $13.61 million lifetime exemption. Unless you're planning on giving away $14 million before you die, you write a 0 on the tax-owed line. You mail the form, and the audit threat vanishes. Just like that. You never needed to touch your IRA. You never needed to panic. The paperwork is the shield that keeps the IRS out of your kitchen. Rescue Step 2. Erase the 25% RMD penalty. If you already panicked and messed up your RMD, we are going to use a backdoor waiver. The IRS doesn't exactly advertise on a billboard. You need Form 5329. This is for additional taxes on qualified plans. First, correct the shortfall immediately by taking the missed RMD. Then fill out Form 5329, but do not pay the penalty. Go directly to line 54. On the dotted line next to line 54, you are going to write 2 magic letters, RC. This stands for reasonable cause. You will attach a typed letter explaining that you suffered severe financial confusion due to banking errors. Tell them you've corrected the mistake immediately. In 9 out of 10 cases, the IRS will look at that RC code and completely waive the 25% penalty. They have a heart. You just have to know which buttons to push. Rescue Step 3. Fight the IRMAA surcharge. If your Medicare premiums spiked, you fight back using Form SSA-44, the Medicare IRMAA life-changing event form. Now, you have to be very careful here. A voluntary IRA withdrawal is not technically a life-changing event. However, if you stopped working, got divorced, or lost a pension in that same year, you check that box and submit the form. The Social Security Administration will legally recalculate your Medicare premiums based on your current lower income, wiping out that surcharge. It's about matching the right event to the right form. Knowledge is power. You need to understand the systemic truth of the American financial machine. The IRS tax code is over 70,000 pages long. It is not designed to punish the ultra-wealthy. They have armies of lawyers to protect them. It is not designed to punish the poor because there's nothing to take. It is exclusively engineered to extract wealth from the unprepared middle class, specifically seniors who rely on common sense instead of the tax code. Common sense tells you that giving your own money to your family should be safe. The tax code tells you it's an opportunity to tax your retirement and slash your health care. Don't let the system feed on your legacy. If you have parents over 65, or if you're planning to help your kids, you cannot afford to act blindly. Share this video with them right now. Send it to your family group chat. It's not just a video, it's a survival guide. It might just save someone you love tens of thousands of dollars and years of bureaucratic hell. Hit the subscribe button and turn on notifications, because on this channel, we don't just read the news. We decode the matrix and we fight back. I'm not here to tell you what to think. I'm here to tell you how to win. I'll see you in the next masterclass. Stay safe and stay sharp.